What's going on, guys? It is Rod Shiva over here. Thanks so much for checking this out. If you are a homeowner, I really feel like there's a chance I might be able to change your entire life right now, and for the positive. So I really look forward to showing you guys some valuable information in just a few minutes that hopefully you can put to use right away. So this is designed for homeowners. And in this case, I'm going to ask you guys to kind of help yourselves over here with some really cool stuff I want to show you. Well, before we jump into the details over here, a couple of disclosures. Like, I'm not a CPA. These numbers, figures I'm going to show you, they're not exact. They're not constant. The numbers are going to vary based off of your credit scores or worthiness. But they're intended on being a depiction of homeownership and borrowing money right now. And that said, though, this is relevant and it is reliable right now. So, quick thing: if you are a homeowner and you are tied into a loan and you haven't refinanced in a while, you need to do this right now, okay? Especially if you're not planning on moving anywhere anytime soon, you need to do this right now. And so you're already probably asking, why, Rod? Why are you telling me I need to go and do something right now? Well, we're living in a once in a lifetime moment in history here. What's happening right now as far as the interest rates are concerned has never happened again. We have just touched an 11th time low as it relates to the cost of borrowing money and purchasing a home or owning a home, or however you want to call it. The 11th time low in history. This has never happened again. Okay. So I want to take a look at these details over here with you and explain some of them a little bit more. This is a Freddie Mac mortgage survey, and this is a historical view as far back as they basically were surveying. And this is basically like the cost of borrowing money from a historical timeline. Now, where we're at as we're traveling all the way across is right at this rightmost point. And if you can't immediately tell, the blue line, which is the most common loan, a 30-year fixed loan, is pretty much at the bottom. It is at the bottom. And I think a better scope of looking at this as it relates to more recent history is possibly just looking at the last 5 years over here. Now, as you see the fluctuations, the big takeaway is going to be this red line. This is where we're at as far as today's interest rate, all the way the furthest point to the right, as you can see to the left. And then obviously, as we just looked at the historical standpoint, it's just never been lower. Now, what this really means is, again, the cost of money is as low as it's ever going to be as far as we know right now. I think there's different ways of kind of looking at this. So I think one quick snapshot is an affordability model. So if you're someone who, I'm about to go into some deeper numbers. If you don't really absorb all that things, I think the easiest thing to look at is what kind of a payment can you afford? And what you're looking at over here is a $3,000 month mortgage that you're able to afford. And to point out this area on the right, this is a scale showing you how much money you can basically borrow. And this is kind of like older points in history. This is what we're looking at right now. So if you can afford so much more in that same $3,000 payment, well, what do you think it's going to do for the home that you're in right now that you have no intentions on moving away from? That's what we're about to take a look at. So what I want to start out with is imagining that we're just looking at a simple $600,000 loan. Well, if you bought in like Q3, Q4 of 2018, I'm using this example because this is really similar to my situation. This is when I got in. If you're borrowing $600,000 at this point in time, your mortgage payment is roughly around $3,040.11. Now, if you're looking at this exact same loan under today's conditions at 2.875, which is probably the real rate that you'd be able to get on this, well, under the same scenario, you're looking at a payment of $2,489.35. Now, this is a really, really big drop, and there's a few things to highlight. A couple things to point out. The total of your 360 payments that you're going to make over the course of 30 years is drastically different. You're talking about going from a 7-figure total payoff amount to a 9-figure amount. This means that basically you're just burning less money if it isn't already obvious by your monthly payment. There's a couple other things I want to highlight in here. That's these red arrows. Now, this is kind of like a cross section of your debt that's declining. The red line is kind of like your debt that's declining. So one is further out. The big thing to look at is, why is the one on the top further out? That's because when you have a higher interest rate, that means that you're actually paying yourself at a slower rate than you would be at the lower rate. That's not just including just the total payment that you're making. Obviously, that's a lot less, but you're also paying yourself way slower with that higher interest rate. So take a look at these boxes I made for you guys. This is basically looking at the first 6 years of a loan. What you're looking at in the green section is your principal. That's the amount of money that you're paying yourself each time you make a mortgage payment, versus the yellow area is the interest on the loan, right? So that's the money you're basically burning and throwing away. Now, the bottom box has the exact same years highlighted, but it's significantly larger than the one above, because you are paying yourself more in the beginning of the loan when you have a lower interest rate. This is a really, really important fact as we start to go further down this rabbit hole of savings that you really should take advantage of. So when you really break down, looking at just straight numbers, I want to give a couple hypotheticals. Now, if this is year one at that 4.5% interest rate when we're first getting in, a couple things I want to highlight over here. Over the course of your first year, you would have burned on interest a little less than 27,000, and you would have paid yourself a little less than 10,000. Okay, and this is how much your mortgage balance would be. This is how much debt you still need to pay off. Now, what does that look like on year one as it relates to 2.875, which is probably what you would get on this right now? Well, you would have only paid 17,000 in interest, and you would have paid yourself a little less than 13,000. Both of those figures should be jumping out at you like crazy. 17,000 is a lot less than a little less than 27,000. That's, again, less money that you're actually burning. In addition to that, you're also being way more efficient with what you're paying yourself. A little less than 13,000 is obviously a lot more than a little less than 10,000. Both of those figures mean that you're wasting less money and you're paying yourself faster. Hopefully you're starting to see why this is so important, because if you can trade your loan in, this is a no-brainer. The other thing I want to point out too is your principal balance. So how much debt you have, you've actually paid your debt off a little bit faster in year one. Now, this is really important because this shows you the principle of like the savings. But I think one thing that will help it to stick a little bit more is, imagine a 10-year outlook of this, okay? Because this is compounding things that we're looking at. So if you were to flight things out over the course of 10 years, what you're noticing over here is your principal balance would be, what you would still owe is about 465,000, versus 10 years out with a lower interest rate, it would only be 436,000. So tens of thousands of dollars worth of savings, in addition to, tens of thousands worth of principal balance reduction, in addition to the obvious facts that you are paying yourself at a faster rate and you're burning less money and your overall payment is less, right? So hopefully this is starting to really sink in and you're able to see the value that we're looking at over here. Okay, these are very, very different numbers. So a few summary points I want to make. Your payment after this changeover would have been $550.76 less. That's an obvious thing. That is a no-brainer. That's good. Now, if you could have afforded, if you had no problem affording your prior payment and you made the exact same payment before you refi, you're going to pay off your loan even faster. You're going to be chipping away at that debt even quicker. You're going to own your home outright if that's your long-term plan. But ultimately, this is just how you're going to save more money down the line. If you're a newer homeowner, right, again, you're paying yourself way faster in the beginning of the loan, meaning that if you are ready for a change 5, 10, 15 years down the line, you're in a better position than if you did not refinance, right? So maybe you're not in your forever home, but you have more cash in your pocket. That's the bottom line. And that's really what you want to make sure that you're taking advantage of. And then the other thing is, in the total side-by-side loan scenario, and you can't go back in a time machine and say, oh, well, I want this loan now. If 2 years ago, I can't make a 30-year loan be like 28 years, generally speaking. But if I were to do that under the exact same principles, that in an apples to apples exchange in that loan, we're talking about saving, in this case, $200,000 over the life of the loan. That is not anything small by any measure here. So, a few things that are really amazing for you that are watching this right now is, one, lenders are dying to give away this money right now. They have a feast or famine lifestyle. So you have these lenders working around the clock really right now because they can't miss out on the opportunity to lend you this money right now. This is just the greatest time of their lives, in the sense that they're not going to get a chance to give you inexpensive money. You're the beneficiary here if you take advantage. And the other thing is, your competitive lenders, they can refinance you at no cost to you. It's not a joke. There's no gimmicks. I'm not selling you anything on this. Literally, these places will do it without charging you a penny if you talk to the right ones and you are communicating exactly what you want. So guys, this is a really big no-brainer here, okay? And I just only want to leave you with 3 short closing messages. 1, take advantage of these times, okay? We are not guaranteed this opportunity tomorrow, next week, next year, okay? Again, this is history in the making. You need to take advantage of it right now. The second thing is, if you found this video to be valuable in any way, or someone that can benefit from it, just please share it with them. That this information, I think, is really valuable, and a lot of people don't talk about it. But if there's any level of understanding that you got here, I'm hoping that somebody else does. And the third thing is, just be good to each other. As I mentioned in this video, I don't have anything to gain. I just am sharing this information thinking that this is something that is doing good. And so I hope you can use this inspiration just for yourselves to help somebody else, if you are so able to do that, just because times are tough, but we can always work on being better. So that's everything that I wanted to show you guys. I hope you found this information valuable. Again, if you do like it, please share it. And outside of that, I appreciate you guys checking this out. I hope you save a lot of money over here in your future. Okay. Thanks.